Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio and cut right through all the market weakness. Today, we're putting PepsiCo on the anvil. You know, their latest earnings report, it looks solid on the surface, kind of like a gleaming piece of forged steel. But if you look a little closer, you might just start to see some hairline fractures. And that's the real conflict here. They had a monster quarter, amazing performance, but the blueprint for the future, well, it looks a little shaky. So we're here to stress test this stock. Is it really built to last, or is it actually built to fail? Let's get into it.
Okay, so let's just dive right into the heart of it. On the left, you've got the engine of the whole bull case. First quarter revenue shot up a massive 8.5%, and they didn't just meet their earnings per share estimates, they blew right past them by almost 4%. I mean, these are the kinds of numbers that build real confidence. This is that solid foundation you absolutely want to see in a consumer giant like this. It shows they've got pricing power, it shows they can execute, it shows pure strength. But hold on a minute. That's all in the rearview mirror, right? Now look over to the right. While they were popping champagne corks for that strong quarter, their own management team was out there telling Wall Street, hey, cool your jets for the rest of the year. Their guidance for 2026 actually came in below what the street was modeling. So the question that every single investor has to be asking is simple. Why are they suddenly hitting the brakes? If this machine is running so hot right now, why are they forecasting a slowdown? That right there is the crack in the armor, and that's what we're going to hammer on today.
Exactly. And look, to even begin to understand that weak forecast, you first have to respect the sheer strength of their current operation. So let's do that. Let's build the ironclad bull case. We're going to examine the pillars that are holding up this Q1 earnings beat. Because these numbers, they aren't just good. They tell a story of a company that is firing on all cylinders, doing all the heavy lifting, and really proving its dominance in the market. Let's drill down into the core components of this performance.
Okay, this is the first pillar right here, 8.5%. That's the year-over-year net revenue growth. Think about the environment we're in, where everyone's talking about the consumer getting squeezed, about wallets tightening up, and yet PepsiCo still managed to grow its top line by nearly double digits. Now, this isn't just them passing on inflation costs. This shows incredible brand loyalty and a really effective market strategy. It proves that people are still reaching for their Doritos, their Gatorade, their Pepsi, no matter what the economic climate looks like. This number is a testament to the durability of their brands. It is a foundational block of pure strength.
And then you see this number, which represents a massive power surge in their profitability. A 27% jump in GAAP earnings per share isn't just growth. It shows that the revenue they're bringing in is flowing directly to the bottom line and then some. It means their cost controls, their productivity initiatives, the whole operational machine is just getting more and more efficient. They aren't just selling more stuff, they're making more money on every single thing they sell. This is the kind of operational excellence that builds real, tangible shareholder value.
And this just brilliantly illustrates the scale we are talking about. Almost $19.5 billion in revenue in a single quarter. This company isn't just a company, it's a global machine, a titan of industry. Putting this number up really contextualizes everything else. So when you see that 8.5% growth, remember, it's not off some small base. They're adding billions and billions of dollars in new revenue. This isn't some nimble little startup, it's a battleship, and right now, that battleship is turning and it is accelerating. This is the kind of financial firepower that lets a company invest, lets them innovate, and lets them weather pretty much any economic storm you can throw at it.
So, the really crucial point is right here on this table. Look, it's one thing to post good numbers. It's another thing entirely to just decisively crush what Wall Street was expecting. Let's get specific. The consensus on the street was for revenue under $19 billion. They came in at almost $19.5 billion. That's a $500 million beat. Analysts were expecting adjusted EPS of $1.55. PepsiCo delivered $1.61. This isn't just about meeting the bar. This is clearing it with tons of room to spare. This demonstrates elite-level execution from their management. It shows they know their business, they know their markets, and they are outperforming what even the most seasoned analysts thought was possible. This is the very definition of an ironclad quarter.
Okay, fine. The case is made. A strong quarter, a powerful foundation. I'll grant you all of that. But it leads to the single most important question for any investor who's looking forward, not backward. If the foundation is so incredibly strong, why are there cracks starting to appear in the blueprint for the future? Why is the same company that just built this incredible structure now warning everybody that the next phase of construction might be a lot slower and way less impressive? That's where the risk is, and that's exactly where the bear case really starts to take shape.
And that brings us right to the other side of the coin, which builds the entire counterargument. We're going to go searching for the stress fractures in this company. And the first place you look isn't in some obscure metric buried in a filing. It's in what the company itself is telling you about its own future. Their 2026 guidance is the primary source of all this concern. Management is basically flashing a giant yellow light, and it's our job to figure out why.
Just look at this table carefully. This is the blueprint that management laid out, and it's smaller than what the market was hoping for. For revenue, Wall Street was looking for over $98 billion. PepsiCo guided to a range that even at the very high end falls more than $500 million short of that mark. And on earnings per share, it's the exact same story. The consensus was at the tippy-top end of their guided range. What that means is there's virtually no room for an upside surprise, but there's a very real possibility of a miss. Management is actively trying to tamp down expectations. They are telling you, in their own numbers, that the incredible growth we saw in Q1 is just not sustainable through the rest of the year.
And you know what? It's not just me seeing these stress fractures. Wall Street sees them too. The average analyst rating on this stock isn't a buy, it's a hold. Let's just walk through these points. More than half the analysts covering the company, that's 11 out of 20, are telling their clients to just stay on the sidelines. And why? Well, the concerns are pretty clear. They see margin pressure coming as the company has to ease off on all those price hikes just to keep their sales volumes up. They see that slower top-line growth trajectory that management just guided to. We even saw big banks like Barclays trimming their price target right after earnings. So the professionals, the ones who get paid to model this stuff day in and day out, they share the exact same caution. They see the strong foundation, sure, but they're worried the building's design is flawed.
Okay, so that sets up the central debate perfectly. The past versus the future. The skeptic is absolutely right to point out the guidance, but you have to understand that guidance is a direct result of a major strategic shift happening inside the company. For the last 2 years, they've been driving their growth through really aggressive price hikes. Well, that strategy finally hit a ceiling. So now they've initiated what they're calling a strategy reset. They're pulling back on price in an effort to revitalize their sales volumes. The entire investment case for the next year, maybe longer, it all hinges on one simple question. Is this reset actually working?
And this chart right here is the first piece of hard evidence that this reset is in fact working. Let's be really clear about what we're looking at. For the past 2 years, on average, PepsiCo's sales volumes have been shrinking by 1.8% every single quarter. They were losing customers. They were selling fewer bags of chips, fewer bottles of soda. It was a slow bleed, but it was masked by higher prices. Now look at Q1 of 2026. That decline has stopped cold. Volume was flat, 0%. They have successfully stanched the bleeding. In a business of this scale, stopping a negative trend and bringing it all the way back to flat is a massive strategic victory. It's the first critical step in returning to real sustainable growth.
And hey, you don't have to take my word for it. This is straight from the top. The chairman and CEO, Ramon Laguarta, he specifically called this out as a key win in their earnings report. He highlighted the notable improvement in convenient foods organic volume. And that word organic, that's the key. It means real sales volume, not numbers that are just inflated by some acquisition. This wasn't an accident. This was the entire focus of their strategy. They targeted price relief on key snack products, and guess what? It worked. Demand picked up. This quote is confirmation from the command center that the strategy is paying off exactly as they planned. This is proof that the heavy lifting they're doing is starting to move the needle. I have to jump in on that point. Is flat truly a victory, or is it just a sign that they've finally hit a pricing ceiling so hard that the only way to avoid losing even more customers is to just stop raising prices? I mean, getting back to zero is not the same thing as growing. It's just not shrinking anymore. It proves they had a volume problem, for sure, but it doesn't yet prove they have a growth solution. The market needs to see that zero turn into a positive number, and right now that's still just a hope, not a reality that's reflected in their own cautious guidance.
And that brings me to another area where I see some potential danger. It's one thing to talk about operations, but we need to look at the financial architecture of the whole company. Specifically, let's talk about their promises to shareholders. Because on the surface, they're returning a ton of cash, which looks fantastic. But when you really dig into the numbers, you have to ask yourself, is this a generous, confident payout, or is it a dangerous promise that could really strain the company's financial health down the road?
Well, before you frame that as a negative, let's just look at the raw commitment here. We're talking about a plan to return nearly $9 billion to shareholders in a single year. The vast majority of that, almost $8 billion, comes in the form of a reliable, growing dividend. The rest is through share buybacks, which, as you know, reduce the share count and increase earnings per share. This is a massive signal of confidence from management. They're telling the market we are a cash-generating machine, and we are absolutely committed to rewarding our owners. This is exactly what income-oriented investors look for, a stable, predictable, and substantial return of capital.
And this number is exactly why that confidence might be completely misplaced. 94.8%. That is PepsiCo's dividend payout ratio. So let me explain what that means in simple terms. For every single dollar of profit the company makes, it is paying out nearly 95 cents to its shareholders as a dividend. This is a major red flag. It leaves almost nothing left over, nothing for reinvestment back into the business, nothing for major acquisitions, nothing to aggressively pay down their debt, and most importantly, it leaves absolutely no margin for error. If their profits dip even slightly, they will not have enough money to cover the dividend they've already promised. A high payout ratio like this isn't a sign of strength. It's a sign of a company that has to pay out almost everything it earns just to keep investors happy, and that could be at the expense of its own future growth and financial flexibility. It is a dangerous promise.
All right, we've laid out the bull case, and it's built on the solid foundation of a stellar quarter. And we've stress-tested that foundation, revealing some serious cracks in the future blueprint and a potentially risky financial structure. So now it's time. It's time to weigh all the evidence. Let's step back, look at the entire structure, and deliver our final unified verdict for you, the investor. Is PepsiCo an opportunity, or is it a trap?
So let's just recap the whole debate right here on one slide. The ironclad case for the bulls is built on undeniable facts, a strong Q1 beat on both the top and bottom lines, a successful and strategically critical stabilization of their sales volumes, which stopped the bleeding, and a massive concrete commitment to shareholder returns. But the stress fractures for the bears are just as clear. You've got management's own weak guidance for the full year. You have that dangerously high, potentially unsustainable dividend payout ratio of nearly 95%. And you have a Wall Street consensus that is lukewarm at best, with most analysts just advising their clients to hold. It is a true tug-of-war between past performance and future risk.
So here is our verdict. PepsiCo is a stable, powerful machine. There is no denying the current operational strength. They executed flawlessly in the first quarter. But that stable machine is showing clear signs of future fatigue. The warning signs about slowing growth and the immense strain from that dividend payout are just impossible to ignore. The current operation is strong, no doubt, but the blueprint for the future is risky. So for us, that makes this a cautious hold, not an aggressive buy. The foundation is solid, but we wouldn't want to build a new position on it until some of the cracks in that blueprint are repaired.
And so we leave you with this final crucial question to think about. Is that massive dividend a reward for the company's stability and its cash-generating power? Or is it a warning sign? A signal that the company's best, fastest growth days are actually in the past, and now its primary function is to simply return cash to shareholders because it can't find better ways to grow? How you answer that question will determine whether you see PepsiCo as a bedrock for your portfolio or as a potential trap. Think about it. Thanks for watching Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.